Welcome everyone to today's presentation, the orientation for CFRM. And we have our honorable trainer, Mr. Param. And he's a very experienced person for this program, and he'll give an introduction about himself when I give him the floor. And he will also discuss about the modulation part. So let me start off by introducing ourselves. Like, we are World Academy for Research and Development, and we are a UK-based organization. We have registered under the UK Learner Provider, and these are a couple of our ISO certifications that we have. Which one of them is 21,001, 17,024, 30,414, and 40,180. The global impact that we have is that we are currently present in 65 plus countries and offering over 200 plus programs, both academic and certified programs. We have so far trained about 30,000 professionals across these 65 countries, and we have a very nice pool, a very experienced pool of instructors of 132 across 14 countries. And about 30% of our alumni are C-suite role holders, and about 95% is the course completion rate at the first attempt. Now, why World Academy is the right choice? Well, we are the largest professional certification institution based in UK. Our credentials that we are offering are globally accepted. We try to provide the program at an affordable fee with flexible payment plan. We have a wide variety of ranges, and these cover about 115 certified programs, about 30 master's level programs, 40 diploma level programs. Sorry. And we also have a very user-friendly learning management system. And finally, we also provide a digital badge that is being issued through credly.com. It is one of the concern of Pearson Education. Our global affiliation is that we are an accredited institute by NQual. It is an off-qual regulated awarding body in UK. We are an approved center by Cambridge Academy of Professionals UK, approved center of Profqual UK, and Board of HR Certification UK. We are a very proud provider of HRCI, SHRM, and ATT. And a couple of our programs are academically aligned with SHRM. We are partnering with the Institute of KPI Specialist and Academy of Business English and Communication, and also an accredited institute of NPMA UK. Well, our mission for 2030 is to become the #1 professional certification institute in the world and have a presence over 100 countries. And the way we are proceeding, it shows that we might even cover it early. Now, these are some of our recent events that we had. One which we had in, I think it's in August. It was in Kenya and Uganda and in Tanzania. So I'm just going to give you an overview of the graduation ceremony that was conducted, which was followed by a global professional summit in 2025. And similarly, we had this program conducted in Uganda. It's a graduation ceremony for those people over there. It was a very huge gathering, and which was also followed by the summit, which was called International People's Summit 2025. We also had the other event in Tanzania. It was a very good event. There was many people present in this ceremony, which was followed by the Global Professional Summit 2025. Now, as we all are here is because of this orientation today. It's the Certified Financial Risk Management, which is validated and quality assured by Cambridge Academy of Professionals UK. This will be the digital badge after successful completion, means that you have to ensure that you qualify in every assessment areas, and only then these certification or post-completion documents will be provided. Along with the digital badge, you will be provided with a certificate and a transcript. This is how it would look. All the modulations will be mentioned under the transcript. And the features of this program is a 4-month duration program. All these sessions that will be conducted will be on Zoom app. As you know that today is Sunday, so we will be starting these sessions in this particular time in this day. Try to schedule your work accordingly. The free books and materials will be provided, and everything will be available through the learning management system. Now, why the program is offered? It's because it's going to be very job-oriented learning. It will focus on competency framework, which Mr. Param will be explaining more about. It's an extensive practical duration in the course. There will be exercises, there will be explanation of the tools and formats that is necessary. And of course, it's a live session, and the global resources will be used. Like Mr. Param will be providing us with his expertise. Now, in total, there are 8 practical focused modules under this program, which will cover about 32 competencies and 32 learning objectives as well. There will be 80 guided questions provided, and total 8 live sessions, as there are 8 practical focused modules, will be covered. And of course, there will be 8 group activities we will be doing throughout the program. Now, the class management is such: a total of 8 modules. So each module will have one single session. Each session is 2 hours. So every Sunday, we will be meeting for 2 hours. And a total of 16 hours will be covered for this entire program. There will be a review and question answer session after each session. We will be providing the class recording for convenience. And of course, the assessment part will include the exam as well. And the first attempt for the exam is free, and the makeup exam is also free. The materials that will be provided through learning management system, it will be provided after the class has been concluded. So within 24 to 48 hours, it will be provided. I'm sorry, just a moment, please. Yeah. So the class notification or exam notification will be provided through a WhatsApp group. So I believe there are a mixed number of people over here who have already enrolled and who haven't enrolled as of yet. So for them who hasn't enrolled as of yet, for them it is that we will be adding you in a WhatsApp group where all communication will be provided and updates will be provided regarding the program, and where you'll get the class link, exam links and updates, etc., etc. There are sometimes emergencies of the trainer or some natural calamities for which we might have to postpone sessions. So this might end up affecting the sequence of the modules, but we will make sure that all the modules has been covered. And as I've said previously, that the materials will be available on the learning management system. And kindly, of course, whenever you join in the live session, please do rename yourself so that we can keep the attendance during each session. The assessment part, well, there is one final exam that everyone has to attend in order to complete the program, and it will include 50 multiple choice questions. Each question is 2 marks, so that's 100 mark. And you should be completing this 50 questions in 60 minutes. That's an hour given to you. And the qualifying mark is 70%. There is another part of the assessment is the assignments. So the first thing that you will be doing after today's orientation is the pre-course assignment. This is out of the assessment part, but you will be doing it before the next class begins. Then you have 3 class-based assignments that you will be doing in between the module or the sessions. Each class-based assignment is 100 mark, and you have to make sure that you qualify with 70 and above. And finally, we have a capstone project, which will come at the end of the program after completing all the modules. It will weigh about 300 marks. The qualifying mark is 70%. And please be informed that we will be checking the plagiarism and AI detection for this CAPS project. So this is an overview of the assessment. As you can see that the pre-course assignment, it's just practice purpose, so it's not marked. You just need to work on it. It's a simple assignment that you need to do and then submit on the portal. So once the class starts, you will be having the in-course assignments, in total 3, each is 100 marks, so that's 300 marks. You have to qualify in each of them individually. You also have the final assignment, which is the capstone project that we have mentioned before. It's 300 marks, and that is also 70% and above to be counted as qualified. And the final exam is 100 marks, so that's 70% and above as well. So you have to make sure that you are qualifying in all of the assessment areas in order to complete the program. Now, upon completion, you will be getting an electronic certificate and also a digital badge. As I've already shown you the certificate sample, that's what you will be getting within 5 to 7 days of successful completion. That means when the results are published on the portal, then within 5 to 7 days, these digital versions will be available, the badge and the electronic certificate. And the printed certificate will also be provided, and we usually provide 4 times a year. So whichever slot is nearest to the completion of this batch, we will be distributing that slot. Of course, all the communication will be done through WhatsApp. So I think I should stop from this part because the modulation discussion, Mr. Param is an expert, so he will be continuing. Let me stop my screen.
Okay.
Sir,
thanks, Tawheed.
You're welcome, sir. You can carry on, sir.
Okay, let me share my screen first, yeah. Hi, good evening to all of you. I hope you can hear my voice and see my screen. My name is Param.
Perfect, sir.
All right, my name is Param. I'm from Malaysia. What I'm going to do is I'm going to quickly cover the modules that Tawheed talked about in this particular program called Certified Financial Risk Manager, CFRM. Okay. Let me give you a quick overview of me. That's me, Param short, Param Krishnan. I've been a consultant and trainer with PKIT consultancy for finance transformation project management. Basically a business professional with a degree in accounting. I'm a member of the Malaysian Institute of Accountants. I have about 30 years of experience combined with wide range of practical hands-on training experiences, okay, both in the commercial sector, okay, extensive experience in providing in-house and external training with institutions like the Malaysian Institute of Management and the Federation of Malaysian Manufacturers, which is for SMEs. The areas of focus of my expertise will include supply chain management, finance and accounting, project management, change management, service management. Career history started with Prime Computers and moved on to Franklin Porcelain and manufacturing. Then with KPMG Pitt Marwick, which is an accounting firm. Then with Philip Morris, which is the Marlboro cigarette manufacturer. Then I moved on to Compaq in Malaysia and Indonesia. I was based there. Then I went on to HP Singapore. And then I was in Reuters Singapore, which is the news agency. So there's a brief history, yeah. So let me move on. Let's look at the modules that we will cover here under the financial risk management. Now, in the event if you cannot hear my voice or if I'm going too fast, please don't hesitate to stop and yell. I mean, don't yell. Just plainly shout out so that I can slow down. So the modules that we talked about will include module one, which is introduction to financial risk management. Module two, which will cover market risk. Module three, we talked about credit risk. Module four, we talked about liquidity risk. Module five, which is operational risk. Module six is enterprise risk management or ERM. Module seven is regulatory and compliance risk. And module 8 is financial risk management in investment management. Okay, so these are the 8 modules that we will cover. Now, what does this modules comprise of? So I'll give you a quick overview of the module itself. When you look at module 1, the purpose of the module is to build awareness of the role, scope, and importance of managing financial risk in organizations. Yeah. Now, you must understand, financial risk is a very specialized area in accounting. So sometimes you find that you get 1 or 2 topics that you will cover in your accounting module when you do a professional accounting course. So in this program, we are actually going to look into the gory details of financial risk management. Okay, so that is very different. Yeah, the focus is a bit different. Okay, but of course, your accounting knowledge will definitely help. So we, like I told you, module 1 will focus on building awareness of the scope, the role, importance. Okay, what is financial risk? Okay, it's actually a structured approach of identifying, assessing, managing financial uncertainties, of course, to protect value and support the strategic objectives of the organizations. Yeah. Uh, why is financial risk important or why does it matter? Because it protects profitability, okay, enhances the business resilience and decision making, etc. Okay, there are types of financial risk that you will look at. You will look at what is meant by market risk. You look at what is meant by credit risk. You look at and try and understand what is liquidity risk. Okay, as I told you, each of the modules within this program itself will cover the details with respect to the types of risk that we're talking about. Okay, then you look at and try and understand what is the risk management life cycle. Yeah, that means how do you start to identify the risk? That's very important. Okay, you measure and assess the risk, then you mitigate the risk. Okay, and control because you have to find a way to reduce the risk that you're exposed to. That's called risk mitigation. Okay, and you continue to monitor and report so that you know how you're progressing based on the identified risk that you have looked at. Okay. Let's look at module 2, which talks about market risk. Okay, the purpose of the module is to understand risks that arise from movements in market variables. Yeah, that will affect the financial asset values. What do I mean by that? Okay, these are risks. Yeah, these are losses due to changes in market factors like movement in interest rate, equity prices, exchange rate, and commodity prices. So especially when you're dealing with, let's say if your business is in a commodity environment, for example, we may be growing cocoa or you may be growing palm oil, movement in the commodity prices will affect you. Okay, if you're dealing with countries in another, if you're dealing with business with another country, movement in the exchange rate will affect you. So how do I protect my business from the exposure of this kind of risk? Yeah, that's basically what it is. So sources of market risk, like I told you, interest rate volatility, because interest rate movement will impact your loans, for example. Okay, any movement in the interest rate will impact the borrowings, then the amount of interest that you may have to pay, or if you have bonds, if you issue bonds, then how much of interest you need to pay. Currency fluctuations, particularly so if you deal with foreign currency, sometimes your supplier may be a foreign currency and you may be, let's say, transacting in US dollars, but you can be buying from a European country, which requests you to pay in euros. So any movement between the US currency and the euro will, of course, ultimately impact the price because it affects the amount you actually have to pay. Okay, like I told you, commodity price swing, especially if you're involved with the kind of industry. Stock market movement, prices in the stock will also impact you. Okay, these are market risks that you are exposed to. So when we look at all these sources of risk, yeah, we will we will look at how do we identify this risk, how do we measure this risk, how do we let's say mitigate this risk and control this risk and monitor the risk and report so that you know how you are managing and whether the steps that you have taken for mitigation of those risks are effective or not. Okay. So categories of market risk, they are classified in two areas. What is systematic risk? This is market wide. That means it doesn't impact you alone as a business. It will also impact other businesses within the country. So it's actually, that's why it's called market wide. Then there's some unsystematic risk, which is asset specific. So it could be in a particular industry that you could be operating under. Okay, it could be bonds, it could be movement in interest rate, it could be movement in commodity prices. Okay, so you need to know how the systematic risk and unsystematic risk impacts you. Yeah. Then the measurement tools that we may use will include things like VAR, value at risk, which is abbreviated as VAR, as you can see, and other tools that are available for you to measure this kind of risk. Okay. Key instruments of risk mitigation, derivatives. Okay, so you may adopt methods of how you want to mitigate this kind of market risk. Okay, so one way is derivative. Now, application area, trading desk, investment portfolios. Okay, so you may have investment portfolio which may consist of different classes of investment. You could be in the share market, you could be in the commodity market, you could be in the exchange rate change market or rate market. Yeah. So when any movement within there, you can see how can be applied. Yeah. So module 3, we look at what is credit risk. Yeah, the purpose of the module basically to explain the risk that arises from failure of counterparty to meet contractual financial obligations. What are counterparties? Yeah, counterparties will include your suppliers, for example, your customers, they are counterparties. Okay, so there are risks that you will face. For example, if your supplier does not supply the goods, how do you manage that? If your customer does not pay your accounts receivable, how do you manage that? So these are the credit risk exposures that you look at. So the probability of the borrower defaulting or deterioration in the creditworthiness of the leading to, of course, loss to the business itself. Sources of credit risk, loans and lending activities. Okay, so you could be borrowing. Okay, movement in interest rate will of course impact that. Then you can counterparty exposure in derivatives. Okay, then you got accounts receivable, like I mentioned to you, your customer does not pay you, so you are impacted with a loss because you have to write off your accounts receivable. Accounts receivable arises because you sold goods and services to your customer on credit. Okay, so if when you need to write off, so how do you minimize that risk? Okay, that's what we are talking about. Credit risk components, we look at things like probability of default. Okay, the types of credit risk that we're talking about, default risk, that means a party does not pay you or you don't pay another party. Okay, these are then concentration risk. Okay, for example, you put all your goods in one basket. Okay, the likelihood of the basket dropping, you will, of course, you understand the terminology or the phrase that I've just used. So similarly, how do you spread your risk? Yeah, so that you minimize your risk that you're exposed to. Okay, and of course, there are measurement techniques that can be used, like credit scoring, rating models. Okay, sometimes you use rating agencies, for example, if you want to identify whether you're moving into this area, whether it's been rated by an external credit rating agency, for example, okay, like Moas and things like that. Okay, so you can see whether it's worthwhile investing in this organization. Okay, and similarly, you can also use your own credit scoring for establishing whether your customer is a credit-worthy customer or not. Okay, whether he is able to pay your accounts receivable. Okay. So module 4, we are looking at liquidity risk. Yeah, what is liquidity risk? Okay, it's a risk of not having sufficient liquid resources to meet financial obligations and due. Okay, liquidity risk is okay. You can talk about short term or long term. Short term is whether you are able to meet your financial obligations to pay off your accounts payable, for example. This is money that is owed or to your supplier. That means you're bought on credit and you need to pay back. So this risk you will be exposed to. Okay, the inability to convert assets to cash quickly and raise funding. So you may hold assets, but you are not able to convert it sufficiently quickly. So do I invest in low risk investment or high risk investment? Okay, low risk investment will give you a higher return, maybe. Okay, and it also it can be quickly liquidated. For example, if you have a deposit in the bank, okay, you can quickly go to the bank and say, I want to withdraw my deposit, for example. So the money is quickly available, but you invest in other things, your money might take some time to come to your organization. So types of liquidity risk, funding risk, yeah, inability to raise funds. That means you may have, for example, property. Okay, so when you want to put your property in the real market, real estate activity, you find that it's not easy to raise liquidity trying to sell your property. Okay, whereas it could be easier if you have, for example, a fixed deposit. You go to the bank and say, I want to uh, uh, renew my deposit, or I want to undertake to remove this deposit, for example. Okay, the market liquidity risk, inability to sell assets quickly, like I particularly told you about real estate, which will take a longer time to convert into cash because you might have to find a reliable buyer who will be able to pay you. So there was a contractual agreement. So there is a time-consuming activity. Okay, what are the drivers? Yeah, market disruption, poor cash flow forecasting. So many organizations, when they do cash flow forecasting, sometimes what they do is excess cash. What do they do to the excess cash? They can use it for the company's growth. Okay, they can use it to invest. Okay, so these are some of the things that they keep, or they can create a reserve. That means they keep a certain percentage of their cash for reserve so that they are able to meet the liquidity risk exposure that they may face in the event of situations. Yeah. So key metric, liquidity convertible ratio. There's a metric that you can use to measure. So when you look at the uh, 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 financial statements like the profit and loss, you know how much interest that you're paying, for example. So you calculate your cover, how much of liquidity you have to cover your interest payments to the bank, for example, assuming you have taken a loan. Okay. So there are, of course, risk management tools like I told you, contingency funding plan. Okay, like I said, sometimes organizations will keep 10 or 20% of their cash as reserve to meet unforeseen circumstances. Yeah. The next one that we will look at is operational risk. What is operational risk? This to infuse risks that arise from internal business processes, systems, people, and external events. Okay, so you find that this basically impacts your operations. What are your operations? Your operations is the business that you do. So if you're a manufacturer of a particular product, that's your business. Okay, but that business can be disrupted or interrupted from internal business processes, maybe weak internal business processes. Or maybe you are using computers, for example, at this age today, most of us will use systems. Okay, so failure in the systems, ability to access the system. And of course, the people who actually contribute to the operational activity itself. Are they sufficiently trained? Do they need more training? Okay, and of course, external events that can happen. So the risk of loss from inadequate or failed internal processes. That means if you have a business process, like for example, an accounts receivable process, what is my accounts receivable process? Does everyone understand in the organization what is my accounts receivable process? Are there weaknesses in my accounts receivable process? Where are the exposures that that I may have to deal with, for example? Okay, collection. So what do I do in terms of collection? How do I devise my credit policies, for example, if I want to give credit to a customer? So These are some of the internal control processes that the company has. Yeah, common sources, fraud. Sometimes this cannot be avoided if somebody chooses to do fraudulent activity. Some companies are exposed to it, but however, there are internal control tools that can prevent these things from happening. Of course, cybersecurity failure, somebody, nowadays, things like ransomware is very common. You get external parties who attack your systems, okay, and the systems, and this is particularly, especially when you are e-commerce company, it's a major impact to you, okay. Technology breakdown, your system is not working. Do you have sufficient controls in place? What if my current systems that I'm using goes kaput? Okay, what do I do that? Do I have a fallback measure? How do I handle the fallback measure? So that's called risk mitigation. That means the exposure that I have is because I use technology significantly in my organization, because I may have software tools, okay? So how do I prevent my software tools not being able to use, or my hardware failure? Do I have an alternative site that I can go to and then continue as if there's normal operation? So these are some of the mitigations that you can undertake. Okay, of course there are regulatory breaches that can happen, supply chain failures. Okay, that means it depends on where you're getting your goods from. What kind of risk are you exposed to? Are you focused on one single supplier? So if that particular supplier is unable to supply you, what do I do? Do I stop operation? Okay, what does stopping operations mean? Stopping operations means you're not able to continue with your production. You're not able to produce the goods and services that you want and sell it to your customer to earn revenue. Okay, so should I have more than one supplier? Okay, these are things that you need to consider. These are the risks that you are exposed to. Okay, so like I told you, operational risk categories will include people to ensure that they are sufficiently trained in the internal control processes of the organization. They understand their job function. They know exactly what to do. Okay, process risk are the processes that I employ within my organization. Okay, sufficient to mitigate this type of risk. Yeah. Okay, so key tools you can use risk control self-assessment. Okay, you can carry out and see what your exposure like. For technology risk, you can look at business continuity planning, BCP as you call it. For example, so in the event my systems fail, I can jump onto a alternative site, for example. So how do I develop my business contingency plan? Okay, so these are the tools that you may use to mitigate this kind of operational risk that any business is exposed to. Okay, now module 6, we talked about enterprise risk management. Yeah, purpose of this module is to explore the risk management across the organization. Okay, now you can focus on your own business. Yeah, so that means you're focusing on a single entity. But however, the entity is exposed to other parties. That means they could have uh, organization in different districts, for example, so which are part of the organization. So you're looking at it on an enterprise-wide or wide scale, yeah? Which you need to look at the organization and say, how will the impact of my subsidiary impact the parent company, for example, okay? How do I minimize my supply chain disruptions, for example, because they are also part of your enterprise, whether you like it or not. You can operate as an individual organization or an individual business, but you need to understand that you need to use a holistic approach to manage this kind of risk. Okay, so it's actually a structured and integrated framework for identifying, evaluating, and responding, monitoring. Okay, that's actually the risk life cycle itself. What are the objectives? To protect value, okay, enable better strategic decision, promote organization risk culture. Okay, what are the frameworks that can be used? COSO, ERM, okay, ISO. I mean, you should know that COSO. I think COSO stands for uh, company-wide social organization, where they actually tell you what kind of internal control tools that you may need to use in this organization for an enterprise. Okay, so you can use that framework, the COSO ERM, okay, and understand it, okay, and see what are the things that you can pick up to look at the enterprise as a whole? Yeah. So what are the core elements? Risk appetite and tolerance. Okay, what kind of risk appetite do you have? Some people have low risk appetite. Some people have very high risk appetite. Okay, what's your tolerance for risk? You need to understand. Okay, so whether you want to, for example, you want to make an investment decision. Okay, now where do I invest? Do I invest in the stock market? Do I invest in the exchange rate market, or the money market? Okay, or do I just go and invest in a bank which is safer, or do I buy government bonds which are very secure because you know that government will guarantee your repayment back? Okay, so these are the things that you need to look at. Then you of course maintain a risk register. Yeah, in most cases, in all situations of risk, an organization maintains a risk register that actually spells out what are the risks that you are exposed to, how do you measure that risk, okay, what are the mitigation approaches that you have taken to mitigate the risk, that means to reduce your exposure to the risk. Okay, you can ignore the risk if maybe it's too small. You can transfer the risk. I mean, you can, like, for example, for vehicles, you can buy insurance. So in the event that your vehicle meets with an accident, the repairs for the vehicle is covered by insurance. So these are some of the tools that we look at, okay, and heat map, strategic integration. So it links risk to the strategy, performance, and governance, okay, as an enterprise as a whole. Let's look at module 7, which actually talks about regulatory and compliance risk. Okay, so what's the difference between them? Okay, what is the purpose of this module? To understand the risks that arise from non-compliance with laws, regulations, and industry standards. Okay, every business entity is subject to compliance. Okay, that means you need to follow the rules and regulations. You are incorporated in the country. For example, you are incorporated in the country that you come from. Okay, when you want to register the company, maybe under the Companies Act within your country, there are rules and regulations that you need to follow. When I need to submit my account, when do I need to whether I need to get my accounts audited, do I need to have a secretary? Okay, and what are the regulations that you're exposed to? For example, any government regulations, okay, tax laws, okay, and of course you also look at what are the industry standards that that are available. Yeah. So these are risks of penalties, because if you do not comply with the regulatory requirements, okay, then if there are regulatory requirements, you will be exposed to penalties, sanctions, and of course your reputation will get damaged due to this non-compliance activity itself. Okay, compliance risk, banking and financial regulations, you need to comply with them. Okay, Anti-Money Laundering Act, you know that, I'm sure you know what that means. Data protection, like in Europe, they have the GDPR. Okay, uh, key compliance areas, reporting obligations, like I told you, when do you need to submit your returns, your tax returns, for example, when you need to submit your financial statements to the regulatory authorities, okay? So conduct the risk, okay? Ethics and governance, okay? What are the rules that your organization follows so that they comply, they're ethical, okay? So that they're supposed to have good governance, basically. Okay, risk controls, compliance programs that you may have. Okay, so people must be exposed to that. They must understand, that they cannot decide to choose to do things their own way. There are rules and regulations that need to be followed. And if you do not follow, adhere to the rules and regulations, you will be subject to sanctions, penalties, and fines. Yeah, of course, you carry out. Many large organizations have internal audit departments within themselves. Okay, so they go about checking out to make sure that you are complying with the government regulation. Okay, module 8, we talk about financial risk management. The purpose of this module is to connect financial risk management in investment decision. Okay, so here is it's peculiar. You look at financial risk, but you are looking at it in relation to the investment decision making. That means every organization, when they have cash or excess money, they will want to do investment. So what are the financial risks that you are exposed to when you undertake such decisions? Yeah. So you need to know the role of risk in investment decision making, balancing risk and return. So you must make sure that you have the right balance, okay, or you strike the right balance between risk and return. What is my risk and what is my return? Can I, for this amount of risk that I'm taking, is the return adequate? Okay, that is what is called balancing risk and return. Okay, alignment investment with risk tolerance. That means you also need to make sure that organizations will have their own rules and regulations about what their risk tolerance and strategy is. Sometimes they put a financial figure. They say that the financial controller cannot make investment decisions more than 100,000. If it's beyond 100,000, they have to go to the board. So this kind of some of the rules that you align your investment with risk tolerance within the organization. The types of risk, you market volatility, interest rate risk, liquidity constraint, not ability to raise money, portfolio concentration. What is portfolio concentration? Portfolio concentration is, like I said, putting all your eggs in one basket. Okay, so I have excess cash. Do I spread it? Okay, do I invest in the stock market? Do I invest in the bond market? Do I invest in the commodity market? So I spread my risk so that in the event that one of the markets go down, I have other markets that can support. So you have a right balance. So uh, it moves away from portfolio concentration with the attitude toward diversification. Yeah. So counterparty and systematic risk that I talked about just now earlier, systematic and unsystematic. Systematic is market wide. So movement in interest rate can impact you, okay, impact your loan, okay. Portfolio risk measurement, risk adjusted rate, okay, there are tools that you can, ratios that you can use like the Sharpe ratio or Sortino ratios, which you will cover within the specific module itself. So I'm just telling you that this is how you measure this kind of risk, yeah. And correlated and diversification. I talked about diversification. That means you don't put all your eggs in one basket. You diversify. Okay. And of course, you can do scenario analysis, do some stress testing. What is my worst case scenario? What is my best case scenario? How do I balance, like I told you, between the risk and return? Okay, so that's all about the modules. Yeah. So what I will do is I will run through the learning outcomes of this program itself within the 8 modules so that you quickly understand what you're going to pick up from attending this session. Yeah, it's a very effective session. It's a very comprehensive session. So those people who have a finance background, I would strongly recommend that you participate in this module, I mean, in this program. Okay, what are the learning outcomes? Okay, what are you going to get out of it? Comprehend the concept and types of financial risk assessment. Okay, you understand what, as I explained to you in each of the modules, the definition of what is market risk, what is credit risk, what is liquidity risk, how do you categorize your risk? Okay, how are they interconnected? Okay, are they interconnected, and how does the interconnection impact you when you make a decision? Then you analyze risk in investment portfolios, like I mentioned, risk measurement, portfolio risk assessment, scenario analysis. Okay, worst case, best case. Portfolio risk assessment is, do I put all my eggs in one basket? Okay, so you understand this, yeah. So that's what you're going to get out of this, yeah. And then you will also learn to understand some risk mitigation strategies that you will come across, yeah. For example, hedging. Okay, so if I'm going to, for example, give you a very simple example. For example, if I want to, if I'm an organization, okay, and I have a supplier that is coming from another country, let's say I'm based in US and I buy from a supplier that is based in Europe. So, and the supplier requests that I pay the supplier in euros. Okay. So any movement between the US dollar versus the euro will be impacted. So what do you do when you are exposed to this kind of risk? What you do is you hedge. You go and buy the euros, for example, at a certain price. So you go and participate in a certain financial market, okay, in the exchange rate market, for example, and say I want to buy certain amount of euros for certain amount. So in the event that any movement, whether lower or higher, it is hedged. Yeah, that's what called hedging. Yeah, very quickly when you look at the detailed modules, you will understand it better. Diversification skill, you will understand that you do not put your eggs in all in one basket. That's the diversification skill. That means you've got to think holistically and broadly. Okay, asset allocation. How do I allocate my asset? Do I focus on a particular? Do I focus on real estate, for example? What is the risk if I exposed to real estate, for example? Okay, of course, you implement the risk management framework itself, knowledge of the framework, policy development, compliance to make sure that you understand these things. Okay, utilize tools and technology for risk management. There are tools available for you to be able to calculate this thing. So you actually learn how to use these tools. So you actually pick up skills on and improve your software proficiency, for example. Okay, and you improve your data analytical skills. Okay, so these are things that you will get out of this module itself. Yeah, and you learn automation. Yeah, and of course, in this current day and age, we are all talking about AI. Okay, so when you pick up all these tools, what does it help you do? Okay, it basically enhances your decision making under risk. Okay, I know that I'm exposed to this kind of risk, so based on the fact that I understand what I'm exposed to, what is the decision that I'm going to make? So your decision making process becomes more effective. Yeah. So you become risk reward balancing. As I explained to you, you need to make sure that if I take this amount of risk, what is the reward that I'm getting, and should I go ahead and proceed? Okay. Of course, there are behavioral insight. Then in a crisis situation, how do I manage those situations? Okay, build strategies and an ethical perspective, long-term planning, ethical decision making. Okay, make these policies, procedures, and internal controls available to the organization so that they conduct themselves in an ethical manner. Okay, then you also will help you explain your decisions that you have undertaken with the understanding of the risk, so that you can explain why you have made this kind of decisions and improve your stakeholder engagement, both to your suppliers, to your internal management, to your board of directors, to your customers. Yeah. So, of course, it gives you an exposure to the real world case scenarios, how to apply them practically, learn some innovative practices. Okay. Achieve cross-disciplinary understanding. Yeah. So you look at it in a very holistic manner. Okay. Integrate with other disciplines, especially accounting, particularly so. Of course, prepare for your professional role in risk management as you are doing now. If you undertake this program, you are actually preparing yourself for certification readiness. Okay, so you gain a foundational knowledge for pursuing certifications like financial risk manager or professional risk manager. Okay, so that's in essence what you will pick up from this course. Yeah. So in summary, we looked at module 1, introduction to financial risk, module 2, market risk, module 3, credit risk, module 4, liquidity risk, module 5, operational, module 6, enterprise, ERM, module 7, regulatory and compliance risk, module 8, financial risk and investment. Okay, that's the end of my presentation. So if you have any specific questions with respect to any of the modules or this program itself as a whole, in the context of trying to understand what will be presented, you can ask me or any other related questions, and I'm sure the host and the co-host, the other parties that are present from Ward Academy can explain to you those things. Okay. So thank you very much for your patience. I hope I've given you an insight of the program and you have understood what you've been going to be exposed to. Yeah. All right, guys. Thank you so much. So I look forward to any questions you may have. Okay.
Thank you, sir. Thank you very much. I hope people understood what the entire course is all about. And I would like to take questions. If it is about the modulation, Mr. Param will be talking about it. And if it is about the administrative part of this course, then of course I'm going to answer that. So you guys can raise your hand if you have any questions. Any questions, or if you have issues with your microphone, you can also type your questions. That's absolutely okay. Yes, Jean, please go ahead.
Good afternoon, Mr. Krishna.
Good afternoon.
Should I call you like this?
Yes, that's fine.
Thank you. I wanted to know from the beginning, it was very well explained. I wanted to know if what you have done, is it the whole comprehension of the financial risk management, or we still gonna go one by one, module 1, 2, 3? That's what I wanted to know. And there's the second one. I'm still coming. I'm still coming.
All right.
I wanted to know where the difference when it comes to financial risk management and business risk management. Are these collaborating on the same risk, or the financial risk is different from the business risk? Is what I wanted to know. Thank you.
Okay, your first question is not very clear for me. Can you kindly repeat it for me, please, so that I can explain it to you further?
Which one?
The first question.
My question, I wanted to know, it was what you have explained, it was very clear.
All right.
So, because you have started from module 1, module 2 until module 8,
All
it's
right.
not the first time that I know you, because I'm just from finishing with a corporate financial analyst. I was one of your students.
All right.
So why the way, because I see the way we have taken this corporate finance, it has taken us a bit. It was the first, you go first module, the
Okay.
next second module. But on the view today, I've seen that you went through module 1, module 2, module 3, module 4 until module 8. So this is
All right.
what I want to know, that it's like you have put together all the module, then you have explained it. So I wanted to know if is it that you're gonna give again in detail, or was just once for all?
No. Okay. The objective of this presentation is an orientation, yeah, meaning which we are just giving you a glimpse of, if you choose to attend this program, this is what you will get. That means each individual module is a separate session. Okay, similar to what.
Okay.
Okay,
Yeah.
that's your answer to your first question. To answer your second question,
Okay.
what difference between finance and business? Okay, I mean, it is been what's the right word I should use? Let me think of the right word. Yeah. When you look at business, what are you looking at? You are actually looking at the enterprise, right? You're looking at the business, we are looking at it holistically. Okay. So when you look at the business holistically, there are components where in this module itself, where I think in module 6, you look at enterprise risk management. So you look at risk in the context of the business. Okay. And each individual module will cover the exposure that you may have. And you must not forget that each of these modules are connected to finance. Yeah. Okay. Because you need to, I told you about the risk life cycle. What is the risk life cycle? The risk life cycle is identifying the risk. Okay, so you identify what is the risk that you're exposed to, whether you're exposed to market risk, whether you're exposed to liquidity risk, whether you're exposed to credit risk. That's the first thing that you do. Okay, then you measure that risk. What is my exposure like? Okay, if I do not do this, what will happen to the organization? Will the organization suffer a loss? And what kind of expected losses that will I suffer if I don't address this risk? Okay, then how do I then mitigate that risk? That means what steps do I have to take so that I can reduce the exposure of this risk to me? Okay, so if I am exposed to a particular risk, I identify this is the risk. Okay, I measure it. What is my expected loss that if I don't address that risk? Okay, take a simple example. Yeah, for example, you have a vehicle for
Hey,
an organization. Okay, so you buy a vehicle for your organization. Your vehicle that moves from your company to point A to point B on a daily basis can meet with an accident. If it meets with an accident, there is a loss that you're going to suffer as a business. Okay, the loss is the cost of repair. Okay, that means you're going to go and take that vehicle that has been damaged to go and have it repaired. If it's small, it's something that you can tolerate. That's based on your risk tolerance or your attitude towards risk. Okay, but if it's going to be large, you might not take the risk. So what do you do? Okay, you have measured the risk. So if if let's say my vehicle is a total write-off, I might lose 100,000. Let's say, for example, if I have a long container, okay, if I lose that container, I might lose 100,000. So I don't want to lose it 100,000. So what do I do? And I don't want to pay the 100,000 if I meet with an accident. What do? I buy insurance. So that's called risk mitigation. Okay. Then you monitor as you move along and to see whether I should reduce my insurance premium because the value of my vehicle has come down. So the premiums will go down. So I revise the situation. So that's how we're going to talk about it. Okay. So one of it is you look at it holistically, but you must look at it in your own business context itself as to what you're exposed to. Did I address your question?
Yes, you have answered my question, sir.
All right. Thank you very much. So I hope
Yes.
you will be happy to attend this module just like you are attending the corporate finance, yeah?
Yes, of course.
Okay, thank you.
great. Any other questions? You can raise your hand and then ask. All right, or you can also type your question. I think we are answering the.
Excuse me.
Yes,
Excuse me.
please, Christian.
Yes,
Please go ahead.
sorry. I would like to know if this session will be only on Sundays, or are we gonna have
Yes.
another? Okay.
The sessions will be on Sundays. It is going to be the same time as we have started
Okay.
today's orientation. It's going to be about 2 hours long. And you have to make
Okay.
sure that you schedule accordingly and also keep a stable internet to be connected properly with the class.
Thank you. Thank you.
Thank you for the question. Yes, Jean, sir, go ahead.
Yes, thank you very much. Mr. Krishna, there's another question that I will want to know if analyzing financial risk involves analyzing also balance sheet, income statement, cash flow, or we just see the risk. We just think that this can be a risk. Like you have seen, I have to reduce what is the insurance. I have to do this, or I don't know. Just wanted to know if it is involved also analyzing from the view, the balance sheet, income statement, if something like that.
Okay, fine. Okay, I mentioned to you there are two types of risk. Yeah, one is systematic risk and one is unsystematic risk. Systematic risk is market wide, yeah, meaning which movements within this kind of exposures like movement in interest rate, inflation will impact all organizations. So it's so within the country itself. So the inflation rate will impact your business, the movement in interest rate will impact your business itself. Okay, so you need to look at it from the context, but you cannot separate yourself from the financial statement, yeah, because you need to look at your financial statement. So when you look at your financial statement, you need to see, for example, when you want to decide on investment, you need to decide how much money in excess do you have. So where do you find that information? Of course, you need to go back to your balance sheet to look at your cash reserve. Okay, so you cannot, for purposes of assessing the risk and for purposes of quantifying the risk, you have no choice but to go back to the financial risk. Okay, so some risks that like unsystematic risk, which are peculiar to your organization. Okay, that means it's exposed. For example, your people are not properly trained. That's a risk that you take, because when people are not properly trained, they will not be effective in carrying out their job. So how do you address that risk? You need to conduct the training. What is the value of my exposure if there's something someone does wrong? Okay, especially depending on the type of product that you make. So you cannot run away from that. Yeah, so that's how you need to address it. Yeah, I hope I
Yes.
made myself clear.
Yeah. Mr. Krishna.
Yes, yes, yes.
Yeah, yeah. A quick one, please.
Good.
You were talking about the operational risk. I would like to know, how do you identify operational risk within a business unit or a department?
Okay, like I told you, what is operational risk? Operational risk is a risk that your business is exposed to. Okay, so you first start with, say, what is my operation? My operation is, let's say, manufacturing product X. Okay, that is my operation. For example, you are a manufacturer. Okay, so when you look at what are the things that can impact your operation, okay, there could be processes, whether the processes that I have in place are effective. Okay, that means people are carrying out their jobs in the way they are supposed to do it. Are there instructions to people to do the jobs the way they are supposed to do? Okay, are the people sufficiently trained? Okay, and what is my exposure if I don't train that people? What are the things that I will get rejected when I come to the end of the product line, for example? Then, if I use systems, what's the exposure to the system? If the system goes down, what happens to my shop floor? Okay, so this is how you evaluate the context of operational risk within the business. You look at what are your operations, what are the things that you need to do to your operations. You need, of course, people, you need work processes, you may need technology, which may include IT and equipment. Okay, so you need to look at the entire scope of it and see what you may be exposed to. So that's how you look at operational risk in the context of a business. All right?
Thank you. Thank you.
All right.
Okay, in relation to that, how, how does internal audits help manage operational risk in the internal audits within a corporate institution?
Okay, if you have an internal audit department, okay, the internal audit department has broad functions, yeah. So they can go and review the processes, they can go and interview the people. Then the people who are doing the business will explain to the internal auditors and say, look, I have joined this company for 3 months, but nobody has told me exactly what I should do. I'm just learning by the day. Okay, so this internal audit people can gather this information, which is one of their roles, other than, of course, looking at the regulatory compliance. One area is they can look at whether the people, there are processes that are in place that are being followed. Let's say you have an internal control procedure, for example, how are goods brought into the company, how is it stacked into the warehouse, are those processes being followed? So the internal audit people can review those business processes and suggest improvement to these business processes. Is that okay?
Yes, yes, yes. Thank you very much. Thank you.
You're most welcome.
All
Anyone?
right. Any other questions, please?
Well, I'm Devashish. I would like to know that in the credit risk part, whether it will be commensurate and it will be it will cover the Basel 3 related topics and IFRS related topics in the credit risk part? Since I am from a banking background, I would like to know about it.
In relation to credit risk, is it?
Yes, yes, yes.
Yeah. In relation to credit risk, I mean, like what is the identification of credit risk? Yeah, for example, your customer is not able to pay back your accounts receivable. You sold your customer on credit, and that becomes your accounts receivable. You need to collect the money, right? Because you need to convert that. Okay, so what are your terms and conditions before you offer credit? Okay, so that is something that you need to review. So there's an internal control procedure in place that says that when I review my customer, I must request the customer provide me with the financial statements, with the banking record, with the history of his operations, the suppliers that he is currently supplying to. These are all the information that you require so that you are able to use whether you are engaging with a reliable, credit-worthy customer, for example. Okay, and similarly, that will apply to your supplier itself. Okay, so whether you're dealing with a noteworthy supplier. So you cannot run away from looking at the financial statements and the processes in place. Yeah.
Well,
Anyone else?
I would like to know that will it include any maths related to Basel 3, which actually covers operational risk, market risk, or credit risk, or not?
Okay. You're talking about Basel 3.
Yeah.
Okay. And the Basel 3 is a separate financial requirement, yeah, that was introduced because of the financial crisis. I'm sure if you've heard of Basel 3, since you asked me about Basel 3, it is a specific type of regulations that were introduced for banks, basically, okay, because of the financial crisis that happened in the US, for example, okay. So we will not go into the details of Basel 3 because it's basically a US based kind of standard that the banks have to comply with, okay. And I think many other banks follow it because there's a lot of items in there which comply with regulatory compliance so that you will not face the kind of risk that we're exposed to during the financial crisis. I hope I addressed your question.
Yeah, exactly. Thank you.
Okay.
Great. Any other questions, please? All right. I think there's no other questions, and I've answered pretty much every questions in the chat box. We would really appreciate. Oh, yes, Gene, sir. Go ahead.
I've got a question that I want to ask Mr. Krishna. Mr. Krishna, my question is something that I want to evaluate for a financial risk between two companies. One company, it's in South Africa, it's a manufacturing, and another company, it's in Namibia. I don't know if there's people from Namibia here. And the one in Namibia has a market, but one in South Africa has the product, which is new product. And the one in Namibia want to be supplied the product on credit. How do you help the company in South Africa to evaluate the risk that is between? Because this one is in Namibia, he has got market, but this product is a new product. Is asking to be on credit, and then they have to be a credit assessment. So how do you help here to evaluate the risk between the company in South Africa and company in Namibia, while this company has a new product, but this one has a market, but he wants product on credit?
Okay. All right. I mean, you need to look at the differences, yeah, between the two companies. Yeah, what are the differences between the two companies? Okay, so you need to look at the quantitative uh, 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 figures that you may have. Okay, and you can also need to look at the qualitative approach to this determining the risk exposure. Okay, so you have one company which is new and one company that is been in the market for some time, and probably, they've been doing business with many organizations. So you need to evaluate it from a standpoint of reliance. Yeah, who can you rely on? Okay, so whether you look at A or look at B. Okay, and what are the things that are available? So the first thing that you will do to evaluate the risk is to look at whether they are credit worthy or not. Okay, now. Okay, so you need to look at your financial statements, you look at their current supplier base, which your other party might not have, okay, and you look at the current financial statements, and then you need to address and look at the qualitative. Can I take a risk with the guy who's new, or can I go with a guy that is in the market for a long time? And you can, for the guy who's been in the market for a long time, you can talk to his existing or her existing customers, okay, or whoever they are dealing with, okay, their bankers, for example, so that you know which is more credit worthy and what is your risk exposure to it. That's how I would look at it. Okay, that means I evaluate them from a credit worthiness point of view and see what is the risk that I'm exposed to. Okay, and the other thing that you need to look at is because they are in two different locations. I'm not very familiar with Africa, and I'm not sure where is A and B, but I would assume that you need to look at it from, let's say, the supply chain context. Okay, what is the availability? Is there going to be any disruptions if they are supplying you a product? Okay, what are the likely disruptions? How are they going to supply the product to you as compared to the other party? So you look at the supply chain risk that you may be exposed to. Okay, are they transporting it by ship? Are they transporting it by lorry? I don't know. Okay, so these are some of the things that you need to look at it in the supply chain context and evaluate whether you have any exposure to the supply chain. Maybe it may disrupt your production when you're taking it from somebody who's too far away, and there could be supply chain disruption. Or you can choose at it and say diversify. Okay, I have both. Then I either have one and the other, or I have both, so that I can also employ the concept of diversification and eventually also reduce my risk exposure. Okay, so this is how I would look at it.
Great. Thank you, sir, for the response. So I would like to conclude the session over here, and kindly be informed that the next session will be on the 7th of December. So whoever wants to enroll can kindly enroll it beforehand. And there's a pre-course assignment. Those who have enrolled, they can start off doing it and submit it on the portal. We would really appreciate feedbacks about these programs and improvements that is required. And also, we would really appreciate if you could share with the people around you, with your network, who you think that requires such programs and knowledge. And with that note, I would like to conclude. Thank you, Mr. Param, for having this session and giving so much time for us regarding so many questions.
No worries.
And also those who haven't enrolled yet, for them, we would like to welcome you and complete your enrollment before the 7th of December. Yeah, thank you very much. I'll conclude the session here. Thank you, everyone.